Hello everyone and welcome back to the channel. In our previous video, we talked about equity-oriented mutual funds, and in this video, we will talk about types of debt-oriented mutual funds. But before discussing the types of debt-oriented mutual funds, it is necessary to understand certain terminologies. Understanding these terminologies will help us in making better decisions and choosing the correct funds for our investment needs. Now starting off with modified duration. Generally, debt funds invest in companies and government securities which has fixed incomes. Generally, the longer the duration, the higher are the interest rate. Let us assume a debt fund having a maturity period of 2 years and 1 year has already passed. Then its modified duration is 1 year. But there are interest rate fluctuations which affects the return of the fund. We will discuss the relationship between modified duration and return in a short while, but before that it is necessary to understand yield to maturity. Next is yield to maturity. Now if you look at the fact sheets, YTM is always mentioned. Now what is yield to maturity? In simple terms, yield to maturity means average interest rate of investments in the entire fund. Now after deducting the expense ratio, the remaining % can be considered as return. Now next is portfolio quality. Generally, the fact sheets provide us with information regarding companies in which funds are invested, and also the ratings of those companies are given. Generally, companies having AAA or A1 plus ratings are considered financially safe, and anything rated below those are considered less safe. If such low rated companies go bankrupt in the future, it directly affects the NAV of the fund. Generally, the interest rate of such low rated companies is higher as compared to companies having ratings of AAA or A1 plus. Moving on to liquid portfolio. Now recently SEBI has announced its new rule that they have to declare the entire portfolio every 15 days. Now this disclosure will help us to know that how much portion of the fund is liquid. Given the economic situation we are facing, it is extremely important to know the quality of the portfolio. Even if the companies are rated as AAA, but if the maturity period is longer, it cannot be liquidated at the time of redemption and its effect on NAV can be negative. Now that we have taken a look at the terminologies, let us understand the relationship between modified duration, return and YTM and why it is so vital before investing in debt funds. The maximum risk in debt funds is that of interest rate fluctuation. In the following example, I will explain how it affects the NAV. I will take 3 scenarios to explain the effects. First scenario being where interest rate is constant and does not change throughout the duration of fund. Let us assume that the fund has an AUM of 1 crore and the interest rate is 8% for 1 year. 6 months have passed and the value of instrument is Rs 104, which means there is an appreciation of Rs 4. Now since the interest rate does not fluctuate, the YTM remains the same and there won't be any effect on the NAV. Moving on to second scenario, where interest rate increases by 2% and becomes 10% instead of previous 8%. Now due to increase in the interest rate, the instruments having lower interest rate experience a decrease in the value. Now the value of the instrument for the remaining 6 months reduces to Rs 103 to match the current interest rate of 10%, which means there is 1% decrease in the NAV. Now please note that on maturity, investor will get the full amount of Rs 108, but due to temporary change in the interest rate, the NAV also changes. And if the investor continues to hold the fund for full duration of 1 year, return of 8% will be received. Here, the modified duration is 6 months and with 2% increase, there is 1% decrease in the NAV. If the modified duration is 1 year, then the NAV will decrease by 2%. So, if the more the modified duration, higher is the risk of interest rate fluctuations. Again, I would emphasize that the effect of fluctuation nullifies at the end of duration of instrument. Moving on to third scenario. Here the interest rate decreases by 2%, which means it becomes 6% instead of 8%. Now instruments providing higher return will experience increase in the market value. The value of instrument increases from Rs 104 to Rs 105 to match the current interest rate of 6% per annum, which means there is 1% increase in the NAV. Now the YTM changes to 6%, and if the investor chooses to exit at this stage, the return would be 5%. And if it chooses to continue to the end of duration, the return would be 8%. In conclusion, if the investor invests in fund in which the estimated time period of investment and modified duration are similar, it nullifies the risk of interest rate fluctuations. For better understanding, chart will be shown on the screen showing the effects of interest rate fluctuations on NAV and YTM. Also, I would like to draw attention to the fact that historical returns in case of debt-oriented funds are of no relevance. The future of debt-oriented funds directly depends on its current YTM and portfolio quality. Now let us look at different types of debt-oriented funds available in the Indian market. Starting off with overnight funds. These type of funds have modified duration of 1 to 2 days and hence there is almost no risk of modified duration. But on the other side, these funds provide return of 2 to 3% per annum only. During the initial lockdowns in the country, majority of the corporates have parked their money in these funds. These type of funds are ideal if the amount of investment is huge and funds are lying idle for 2 to 3 days. Generally, corporates invest in these funds during weekend and continuous holidays. One of the example of overnight fund is HDFC Overnight Fund. Second is liquid fund. These funds have modified duration of 40 to 50 days and hence the risk of interest rate fluctuations is very minimal. These funds currently provide 3.5 to 4.5% of return. Investment in these funds are advisable if you have certain amount lying idle in your savings or current account for the period of 1 to 2 months. Even redemption from these funds are easy and amount will be available as per current NAV. For example, ICICI Liquid Fund. Next are ultra short-term funds. These funds have modified duration of 3 to 6 months, which again has a minimal risk of interest rate fluctuations. These funds generally provide return up to 4 to 5%. These are best options against short-term fixed deposits and also provide higher return as compared to fixed deposits. One of the examples of ultra short-term funds are ICICI Ultra Short-Term Fund. Next is low duration fund. These funds have modified duration of 9 to 12 months. Risk of interest rate fluctuations is low but high as compared to liquid funds. These funds have YTM of up to 4 to 5%. One of the example of low duration fund is Kotak Low Duration Fund. Next is short term fund. These funds have modified duration of 2.5 to 3 years. The risk of interest rate fluctuations is higher as compared to ultra short and low duration fund. These funds give YTM of around 5 to 6%. These funds are best option against 1 year fixed deposits. One of the example of short-term fund is HDFC Short-Term Fund. Next are long duration funds. These funds have modified duration of 3 to 5 years and has higher risk of interest rate fluctuations. These funds give out 5.5 to 6.5% return in their last year. These are best option against 3 to 5 years of deposit. One of the example of long duration fund is SBI Magnum Income Fund. Next are gilt funds. These type of funds invest 100% in government securities and can be rated as safest from the security point of view. These funds have modified duration of 5 to 8 years and hence it can increase the risk of interest rate fluctuations. These funds are advisable to investors who have estimated investment period of 5 years or more. These funds give out YTM of about 5.5 to 6.5% and can be considered a better option against 5-year fixed deposits. One of the example of gilt fund is ICICI Gilt Fund. We will discuss about gilt funds in detail in the upcoming videos. Next are credit risk funds. These funds provide YTM of around 7 to 10%, but majority of the investments are parked in low rated companies. Approximately 70% of investment is parked in AA or A or even lower rated companies. These funds have lock-in period of 1 year and in the meantime, if any such low rated companies goes bankrupt, the NAV drops by % of investment done in that specific company. Hence, these funds are extremely risky to invest in. There are multiple instances of principal amount being wiped off and it is advisable to not to get lured just by higher interest rates. The example of credit risk fund are HDFC Credit Risk Fund. With this, I would like to end this video. Do let us know through your likes and comments how you like this video. Subscribe to the channel for more such investment advice in the future and I'll see you next time.